the last year has seen a huge amount of institutional capital coming into the business aviation market. And if you look closely, on nearly all of the deals, there's a small line saying, advised by Jefferies. And so we're delighted. Jim Palen is one of the people who did fly here in his own personal jet. And I'm going to hand over to Jim Palen now.
Good afternoon, everyone. My name is Jim Palen. I'm a managing director at Jefferies, and I co-run our aviation and aerospace banking and capital markets group, where we focus on companies and platforms and investments all throughout the sector, from the operators, from the maintenance side, FBO, leasing, sort of in all aspects of up and down the vertical chain of private aviation and across the different platforms. What I want to talk to, as Alistair mentioned today, is like the growing presence of what we see as institutional capital coming into the private aviation sector. This is a trend, if I look back 25 to 30 years, when we saw a massive influx of institutional large ticket capital coming into commercial aviation. A lot of what we've been seeing over the last 5 years is very representative of what we saw back in the late 90s and into the early 2000s. So over the past 4 or 5 years, we've seen, as I mentioned, a growing presence of institutional capital. That means non-family office, non-individual sort of retail type investments, but the larger institutional professional money management firms coming into this sector. Those include sovereign wealth, public style investors, which are either those that invest in public companies or pre-public companies through PIPEs, private equity, which we're all familiar with, and hybrid capital, which is a quickly growing portion of the institutional capital space, which really sort of was born out of or accelerated coming out of COVID, as well as infrastructure and other sort of hard asset funds. A lot of investors we see flocking to this space, particularly in private aviation, are ones that want to capitalize on their knowledge of the commercial aerospace sector or the business aviation sector and use that to sort of leverage themselves into a sector which is, growing, if you will, if you compare it to commercial aviation, and where they can leverage a lot of their knowledge and seek valuations that might be a little less than what you would see in commercial aviation and seek higher than average returns. We've also, part of what's driving this influx of capital is, a lot of the existing businesses continue to mature, grow through, or both organically and through mergers and acquisitions. And a lot of the investments that came into this sector 5, 7, and 10 years ago are nearing the end of their natural fund lives. And so while some of the capital coming in you see is to help grow these companies and fund M&A, some of it is also to begin to provide returns and dividends to existing shareholders. I'll break the 4 different sectors down that we're seeing capital flow into, institutional capital, into operators, management, MRO, and some of the FBOs. On the operating side, we've seen a lot of consolidation and a lot of significant growth, and that's only been further accelerated post-COVID, when I think we all learned, whether it be on the operating side or on the maintenance side, scale and vertical integration really matters. Some of the operators that Jefferies has been done deals with include FlexJet, Vista, Wheels Up, among others listed on there. On the aircraft management side, we've also seen a fair amount of consolidation. It's one where not as much capital is coming in, but as those aircraft managers begin to develop fractional programs and so forth, that fleet growth has all been demanding incremental institutional capital. On the MRO side, this is what I would have historically referred to a little bit of the boring part of the sector. But I think coming out of COVID, we all saw the importance of MRO and maintenance activity and what that plays into efficient operations. We've seen a lot of the operators on the left-hand side of this page come in and buy different maintenance businesses, aircraft management businesses, FBOs and make greater investments in their platforms rather than just in the customer-facing aircraft side of the business. The last piece, I think, which Sean hit on a bit, which we've seen a lot of activity in, and Jefferies in particular advised on the acquisition of Atlantic, is the FBO space. There's two large players out there and a couple others that are growing, trying to grow significantly. This is a space that we've seen infrastructure capital increasingly participate in. A lot of the opportunities that infrastructure would traditionally look at have slowed their growth. There's just a lot less opportunity out there. So you've seen infrastructure funds begin to look at what we call core or core plus type assets. These are assets that have infrastructure-like credit and return elements, but aren't necessarily the traditional infrastructure like toll roads and ports and other things that we might think about. In terms of what we see institutional investors looking for in this space, there's really two different pockets. One is the equity side, and that's equity, hybrid capital, and the other is on the debt and loan side. On the equity side, what we're seeing is, obviously we've all seen the trend over the past 10 years where asset managers have become large and ultra large. And with that growth in asset management, particularly alternative asset management, comes the need to do larger deals. When approaching some of the large names we know in the sector, like the KKRs, Blackstones, BlackRocks, and so forth, they don't necessarily have interest in the $5 or $10 or $15 million deals. These are institutions that need to deploy billions of dollars per week among hundreds of different strategies. And so the first thing that we see is institutional investors are definitely looking for size and scale in their investments. When they dedicate teams to this, they want to be able to put anywhere from $200 million up to $1 billion to work in that type of investment. The second is they're looking for scaled platforms which are large and have proven themselves, but platforms that can lead further roll-up in M&A activity in the sector. There are also a lot of the institutional capital on the equity side is looking for ways which they can use their existing investments in other portfolio companies to leverage and help grow the investment that they're making, as well as a lot of the operating partners that they maintain on staff to work with these investments. They're looking for beyond just the initial investment in buying that company or coming in and taking a large sort of minority interest in it. They're looking for platforms which they believe can begin to roll up the sector, whether it's on the operating side or the maintenance side. And one of the things, particularly in two of the large transactions that I'll talk about here in a bit, that institutional investors are looking at is they're looking for large platforms with predictable and proven revenue stream and earnings growth and cash flow, positive cash flow. And lastly, because a lot of the institutional equity that we have seen come in from pension funds, hybrid equity, or traditional private equity funds, because it's not what we call permanent capital. Those funds all have lives. Institutional capital wants to make sure when they come into these investments that there's a clear path towards an exit, whether that be an exit in a sell to the next sponsor or bringing that company public or selling it to some type of sovereign. They want to be able to see where that next exit is going to be. Typical private equity fund lives are between 5 and 7 years with sort of hard maturities in a 10-year period. Besides equity, there's been a lot of debt and leverage coming into this sector to fund growth and to fund, for the largest part, the acquisition of aircraft. We see two different pockets of institutional debt capital coming into the sector. One is your traditional public style debt. These are investors, high yield, loan and bond funds that are looking for sort of traditional 144A, Reg S, public bonds that are very liquid and can be traded by our trading desk. So if they want to get in or out, they have a view in the sector, they can call a desk and they'll be able to sort of sell it, on the wire, if you will. Those type of investors are looking for transactions that are 500 million to $1 billion. And why? Because they're looking for larger scalable transactions, and they know that those larger transactions offer them a lot of liquidity in terms of trading in and out of their positions. Typically, they're looking for ratings because these more public style investors are looking for, generally the sweet spot is single B type investments on the credit side and triple B on the sort of secured aircraft finance side. The other growing portion of capital that we see in the sector are private credit funds. These private credit funds will come into situations where a company can't necessarily get a rating. It may be too early for them to approach the agencies, but they can come in and they can provide, one investor can provide $200, $300, $400, $500 million of capital rather than hiring a bank to go out and syndicate it. And they can come in and provide all the necessary capital plus growth capital, but that generally comes with more stringent terms, including financial covenants and other types of negative covenants, which give them a little bit more control over the sector. So they're bigger, they can help you grow, but they definitely come with more restrictions. You see this type of capital flowing into more early stage or smaller companies. In terms of the underwriting approach, whether it be on the equity side or the debt side, I would summarize the two main underwriting theses are asset coverage or credit. The larger companies, particularly management companies, more asset-light companies and so forth, have developed, in the case of Vista and Flex, which I'll talk about here, have developed sort of large, scalable, long-term contracts with predictable credit. And you've seen credit investors begin to come into this sector. We've raised over the last 3 years close to $4 billion worth of unsecured syndicated public debt and loans for these type of companies. Here again, they're looking for lower leverage, typically in the 4 to 5 times, and they're looking for predictable free cash flow that would allow them to deleverage in the future. The other portion of capital coming in is traditionally asset-based, and that's generally for smaller companies when they're starting up, or asset-heavy companies where investors want to come in and know that they're less focused on the actual credit of the underlying investment and more focused on their ability to have hard assets backing their investment. So if something happens, at least their recovery is very well known because they're going to be able to recover against the asset, not necessarily against the business. A couple case studies I want to run through in terms of transactions which Jefferies worked on earlier this year. In total, we raised $1.4 billion of preferred equity for two of the largest sort of independent, if you will, operators out there. One is VistaJet and one is FlexJet. On the VistaJet side, we worked with a company. We've been their, I would say, their favorite banker for the past 12 years. But we helped them raise a $600 million preferred equity investment that came in part to fund a dividend in return to some of the existing shareholders, but primarily to delever the company on the heels of what has been a 12 to 13 year growth in its fleet. In terms of bringing this type of transaction in, it's typically a little bit large for one party to take by themselves. So we had 3 different investors come in. One was RJ Capital, which is a sort of Asian-focused investor. The second was Andalusian, which focuses in kind of discrete consumer brands. And the third one, which was not disclosed, was a large pension fund. This transaction, in connection with doing this, this was a widely marketed transaction. There was a lot of interest in this. And ultimately, this set the company up on the heels of, again, what had been over a decade of solid growth to delever, restructure its balance sheet by also, right after we closed this transaction, we led a $700 million term loan financing to take out a lot of its asset-based debt. But this transaction and the one that followed it were really Vista migrating from more of an asset-based balance sheet to more of a credit-based balance sheet. The second transaction, which we closed a few months ago, was an $800 million preferred equity investment for FlexJet. Again, the majority of that transaction was used to delever the company and fund future growth in some of its large cabin large cabin business, and part of it was to return capital to some of the existing shareholders. That's a theme that we've seen in a lot of these different transactions that I mentioned at the very beginning. In the case of Vista, Rowan has been in since 2017, and Eldridge has been a capital partner for FlexJet for close to 10 years. A lot of the existing equity that have put money into these businesses to help them grow to where they are here, ultimately looking for some type of return. So the preferred equity that we structured in both of these cases allowed the existing shareholders to take a little bit of money off the table, to delever the company and set it up with a new type of cash flow profile and allow it to continue its growth at a new lower leverage level. This transaction was led by L Catterton, which is a money management arm of LVMH. And in FlexJet, in terms of doing this transaction, they saw significant value in this partnership, not just from the capital that was coming in, but from the branding that L Catterton has with its partnership from LVMH to further grow sort of its overall customer base. In addition to L Catterton, KSL, which is a private equity firm focused in sort of high-end customer experiences, also joined. And then Safra, which is a private bank in Europe, also joined. Both of these transactions will set these companies up to grow over the next 4 to 5 years and continue on their current path. The pool of capital available to support these type of preferred equity investments are very deep. There's close to 100 different firms out there that make these type of investments. But to get back to my earlier point, what we found in marketing both of these transactions are investors are very focused on a sticky customer base, long-term predictable cash flows and contracts, in the case of Flex through multi-year fractional contracts, and in the case of Vista through their 3 to 4 year programs that they sign up. And these all provide the predictable cash flows that these companies are looking at to continue to fund their growth. That's it. I'd be happy to take some questions.
Great. Do we have any questions for Jim? Great. I'm coming straight to Alan.
So I've been watching that investment into FlexJet pretty closely. And one of the things I see is a company like L Catterton with their big base of brands. Would that put them in a position to take over FlexJet?
Well, traditional, when we bring preferred equity into a company, that preferred equity is coming in senior to the existing common. So they're higher in the capital stack in the waterfall, if you will. In exchange for that, they typically, in exchange for that downside protection, they're typically giving up control. So neither of these transactions create any type of change of control today or in the future. But ultimately, as we've seen in the past, when private equity does come into companies like this, usually their first step can be in a preferred situation. The next step can come in and fund common, and they can be part of a larger funding partner down the road.
Yeah, I mean, my assumption is LVMH is looking to take over some part of private aviation.
Well, I think one of the things that the company talked about, publicly is that they saw a lot of synergies between the type of clientele that these type of private aviation operators like Flex, like what their clients have, and other high-end consumer products like LVMH have. So it's a very natural fit. And I think the company, they expect to see a lot of synergies, between the two companies.
Any other old school questions or Slido? Jim, these were obviously two really big deals. But what's quite interesting is that you have been working with Flex, and come and sit down if you want. You've been working with Flex and Vista before this, reshaping the business. With Flex, we saw you were involved in them buying the interiors business, various maintenance businesses. That's a trend as well, isn't it?
It is, and I think, Flex, we worked with them on the acquisition of Flying Colors, which was a very important business. coming out of COVID, we saw the importance of these large operators being able to control their own maintenance functions. If you're just showing up to a third-party operator and you have sort of a large fleet and you're trying to stagger that into their business, it's very difficult to be able to control what's happening to your assets and the overhaul of your assets. These large fleet operators are trying to get 1,100, 1,200, 1,300 plus hours per year out of their fleets. And so that requires a very, sort of commercial airline type approach to maintenance. I think the days in which individual aircraft managers can sort of manage aircraft, from one event to the next, because it just needs to be available for the owner who may be only operating that aircraft 200, 300, 400 hours per year if you include charter. When you're moving into the 11, 12, 1,300, and with some of the larger cabin aircraft, 1,400 hours per year, you need to really be able to control that type of maintenance. And so I think that's why we've seen both on Vista's side and Flex, and if you look across some of the other large operators out there, they've all been making investments in FBO, maintenance, other types of assets where they can control the cadence of maintenance and how their fleet operates.
We've got two Slido questions. In the operator space, where is the break in transaction size that enhances multiples, EV or multiples?
Well, what investors are looking for, I think, is scale. And I think what we've seen are operators that have 10, 15, or 20 aircraft. It's very difficult to be able to compete and grow those assets and sort of amortize the fixed costs of running a large platform like that. When you begin to think about like these large fleet operators who, whether it be on the fractional ownership or fractional lease side or on the program and jet card side, you're effectively selling a call option to your customers. You're selling a call option where they can call on the aircraft in 24, 36, 48 hours or less to generally fly you wherever you want inside that area. That type of dynamic requires sort of larger fleets. And so when we look across the capital raises that we've done over the past 10 years, the sweet spot is really for operators that are sort of in the 30 or 40 aircraft range. They're generally cash flow profitable, and we see a real path towards becoming larger globally and growing the earnings in a way that a lot of the institutional capital that's investing in this space is expecting.
We've got another question. How long does the due diligence process take on a $600 million investment?
Typically, these are 4 to 6 month type transactions. I'll say the diligence that takes place during a preferred equity, it's slightly less than what you would see during a traditional M&A exercise that we might run. But for deals of this size, it's a significant full-on diligence session. Many cases includes a sort of Q of E or outside advisors that are all brought to the table in terms of making this investment.
But presumably not much more than for a $200 million investment.
Pardon me?
Presumably it's not 3 times as much as a $200 million investment.
Well, it's very scalable, and getting back to scale, what a lot of the private equity and infra type funds are looking for is when they're going to deploy all the manpower and bring in the Q of E lawyers, do all the diligence that they need to. Doing all of that to deploy $50 or $100 million just doesn't necessarily make sense. That's why a lot of these assets, a lot of the larger assets, Sean mentioned earlier on the FBO side, you've seen significant interest from some of the largest infrastructure funds out there.
Sean touched on AI. Someone has said, where do you see technology providers and platforms in this space?
I certainly hope that AI is never going to replace the banker. But we do see AI beginning to really, where we think it's going to be most effective is on optimizing the movements and so forth of all these aircraft among these large operators. It is something when we talk about what is scalable. when we talk about efficiently raising assets for capital for a company that has 20 or 30 or more aircraft. That does have the ability to kind of shrink that size. AI can allow smaller operators to be more efficient, but ultimately this is still an industrial business that involves a lot of moving people around. I'm not necessarily sure that that private aviation is going to deviate too far from that.
Okay, and you've touched on this, but could you just explain why preferred equity was chosen for these capital infusions? If you're the operator, if you're Thomas or Ken, why would you choose preferred equity?
Well, preferred equity typically, as I mentioned, is more senior in the capital structure, and it allows for more of a fixed type of return with some equity participation. And so in high growth companies, both of which I would put these in, many times the speed at which the company has grown and the existing shareholders where they see value may not always correspond with where a new investor comes in. And so many times what preferred does is it allows you to bring in capital with more of a fixed type of return and less, or a smaller attachment point, if you will, to the ultimate equity of the company. So if you're the founder of a company and you foresee significant growth in the future, you may choose to bring in preferred equity, which has more of a fixed investment, less participation in all that upside, rather than just bringing in straight common equity. And typically preferred equities also has structures around it which provide for some type of, if not automatic, conversion or refinancing or exit in the future, sort of increasing pressure to be able to refinance them out or pay them off in the future. Again, most institutional capital that we talk about and we brought into the sector is not permanent capital. It's capital that ultimately its funds and its LPs have a 7 to 10 year life.
Great. Any more questions? Final question. Are you going to see more business aviation deals in the next 12 months than in the last 12 months?
I think absolutely, because we foresee more consolidation on all of the verticals that we talked about on page one, whether it be MRO, whether it be leasing, whether it be on the operator side. We see a need for a lot of the large operators to continue to vertically integrate. And we also just see sort of a larger, back to the maintenance point, we've seen the difficulties that individual owners face of having only 1 or 2 or 3 aircraft and their ability to access, whether it be FBOs, maintenance, or other types of things when they don't have that scale. So we do think a lot of that will feed into further consolidation in the market.
So you've already got the mandates for those transfers?
I would like to hope so.
Thanks very much. Thank you very much, Jim.
Thanks.